Let's continue with the decade-by-decade history of the U.S. Fed. Now remember, we're going decade by decade in a short period of time, so we necessarily have to make sweeping statements that aren't altogether perfectly accurate, but they're generally valid. In the 1950s, the Fed was trying to target free reserves. Free reserves would be the excess reserves held by banks minus the discount loans that banks owed. Free reserves were viewed as reflecting the available credit in the system. If there was an increase in free reserves, the Fed would then sell bonds and reduce reserves in the system. But this policy generally engendered a pro-cyclical monetary policy. It would work something like this. A strong economy would raise nominal interest rates and would be accompanied with a lot of lending, but this would cause excess reserves to go down. The Fed would then notice this and then would do open market purchases to raise the monetary base and then raise the money supply. Some other items at this time. The Fed generally did not target interest rates. That's what they had done in the 1940s, and they were trying to get away from that. But all along during the 1950s and 60s, the Fed was looking at both monetary aggregates and interest rates. Policy between 1953 and 1960 was also known as bills only, because the Fed operated only in the short-term U.S. debts and left longer-term debt to be settled in markets. The 1950s are sometimes considered a relatively successful economic decade, pretty good growth. There was low inflation on an order of around 2%, and mortgage rates, for example, were low, 5.5%, 6%. We would get back to those low rates of inflation and mortgage rates in the 1990s and 2000s and claim they were the lowest of all history. But what happened between the 1950s and into the 1960s, 70s, and 80s that got us to change our perception about what low rates were? By the end of the 1950s, open market operations were the main policy tool of the Fed, and discount lending and changing reserve requirements were not really policy tools. And in the 1960s, policy was generally still pro-cyclical. The Fed was still primarily targeting free reserves. The economy was very strong during the 1960s. The economy came out of recession early in the decade and grew with low inflation, at least for the first half of the decade, and then it continued to grow well in the latter half of the 1960s, although inflation started to go up. Now, people attributed inflation to the hot economy and to big government spending like the Great Society and the Vietnam War, but there were others who were making a monetary case, and they were looking at the growth in money aggregates like M1 and M2. These are people like, Milton Friedman. But at the end of the 1960s, it wasn't obvious that we were going to have grave problems in our economy. The 1960s was a great day of economic policy, both fiscal policy and monetary policy. The economics profession was at the height of its prestige, and it looked like as though we had good policy that could steer our economy. This might be a good place to do a quick digression on financial innovation, and it's very, very critical to the monetary economy in the 60s and 70s in particular, because in order to understand monetary economics, we had to know about money. Now, economists talked about a quantity of money called M1. M1 is cash and checking accounts. You can also call them demand deposits. And those were the things that we thought you could do transactions with. There was also a greater quantity called M2. M2 was M1, all your checking and your cash, plus the money you had in savings accounts, or sometimes we call them time deposits. And economists thought that that quantity of money also reflected how much transactions were being done. Now, if we could understand these quantities of money, then we could maybe understand the economy. And the Fed, of course, could control these quantities of money to some extent. But throughout the entire half century, there's been constant financial innovation. Things like interest on checking. Not too long ago, you couldn't get interest if you had money in a checking account. Seems unlikely today, but back in the 1960s, you could not by law. And that law was relaxed. And then there are things like money market accounts and banking around the clock and ATMs and sweeping money out of accounts into another account overnight, and related things like brokerage at low costs and mutual funds and so on. Now, these financial innovations drastically changed what was in M1 and M2 to the point where we couldn't rely on them to tell us anything about the economy. Just to give an example, let's say you're an economist and you believed a lot of money out there meant to be high inflation. So if you saw a lot of M2, you thought that there was too much money out there and that the economy was overheated. But an equally plausible story was that the economy was weak and that people were simply putting money into money market funds. That's M2. So the quantities of money got very confounded, and it made it very, very hard to do central banking. The 1970s was a decade full of economic events. It included, say, the demise of the Bretton Woods system and the U.S. letting the dollar float. It included the energy crisis. It included the big bad recession we had in the middle of the decade, and then a new term, stagflation, which meant high inflation and high unemployment at the same time. The stock market went nowhere during the decade. Anyway, for monetary policy, there was a new Fed chairman. It was Arthur Burns, and he faced an initial crisis to start, and he struggled with it during the entire decade, and he left us in a sense, a worse situation. Let's just look at an example of how it played out. He was trying to target monetary targets like M1 and M2, but he was also trying to target the Fed funds rate, and you really can't do both. Now, for example, in 1974, the economy was in a bad recession, and the Fed funds rate fell a lot, from about 12% to 5%. The latter amount was too low a level for the Fed's target, so the Fed did contractionary monetary policy, that is, selling bonds to get the rate up. But that took money out of the economy at a time when the economy was in need of credit. Then when the economy recovered, income went up and interest rates went up, and the Fed started to buy bonds to get the interest rate down, but that would increase the money supply. So the policy was generally pro-cyclical. Now, by the end of the decade, the economy was in tough shape, and we passed the Humphrey-Hawkins Act in 1978, and that made the Fed accountable to set and hit certain monetary targets. It also set a goal of 4% unemployment. That looked somewhat laughable back then. And now a summary of the 1950s and 1970s, you might say that we targeted money market conditions, either some monetary aggregate or the Fed funds rate. The policy, though, was generally pro-cyclical, meaning that more money was created when the economy was strong. And this contributed to inflation, and it culminated at the end of the 1970s. And concerning the 1970s, it was generally a bad decade for monetary policy, but we might look back and say, was it just a bad decade for real GDP growth, where we were on the low side of 3? And if we had been on the high side of 3 the way we were in the 1990s, maybe things would have worked out a lot better. Anyway, this gets us to the end of the 1970s and a new person in town to take on inflation. By the end of the 1970s, inflation was very high, over 10% and as much as 13%, depending on which measure you used. And Arthur Burns left office in January 1978. Now, for a year and a half, the Fed chairman was G. William Miller. I'll say his run was uneventful in that he didn't make a concerted attempt to deal with inflation. Now, on August 6, 1979, Paul Volcker became Fed chairman. He would make a concerted attempt to fight inflation. It's a kind of muddled story about what he actually did and what actually happened. He was supposedly targeting monetary aggregates, but what he was really doing was he was just trying to get interest rates up, in particular Fed funds rate. He knew that there was going to be a cost to choking inflation out of the economy. Now, the Fed funds rate, which was below 10% earlier, hit about 22.4% in 1981. And indeed, we got a big recession in 1982. Unemployment approached 10%, but inflation did go down. Some economists doubted that inflation could ever come down. They said it was built in, that it would take decades for it to get down. But it did come down relatively promptly. Other economists believe the U.S. long-term growth was below 3%. But the U.S. growth picked up, and we had good years of growth, particularly in 1984, and the economy seemed to recover. Now, to some people, Volcker is a big hero. To others, he was always a big villain. He created a great bad recession. Some people call it the Volcker recession. Anyway, as of about October 1982, the Fed policy was back to targeting interest rates. By the late 1980s, the Fed had stopped targeting money supplies at all. And by 1987, the economy was on a relatively lower inflation track, and that's when Alan Greenspan would become chairman of the Fed.